Welcome to Fidelity Soundbites, a straight-to-the-point, no-nonsense monthly podcast where you'll learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioned, and the outlook going forward. I'm Simon Glazier, your host this month, as Andrew Dowling is taking a well-deserved break. Looking at the shape of the market in the lead-up to reporting season, some stocks have had a stellar run in the lead-up and over the last 6 months, while others have been challenged to say the least. Market dynamics are shifting, pricing power remains paramount, and there seems to be a bigger difference between the winners and the losers. To kick us off, how is the shape of the Australian mid-cap companies in the lead-up to reporting season, James?
Hello, Simon. Look, there's definitely recovery expected. There's about 9% EPS growth expected on a median basis. Averages are a bit different because there's lots of other different moving parts in there. But the recovery is expected. The free cash flow yield is also expected to grow about 1.5%. So. And the ROE is also recovering. There is a very big dispersion between mid caps and small caps. I mean, small caps are down about 20% from highs. That's a big number.
Big number.
Mid caps, similar to large caps, are almost flat compared to where they were about 18 months ago, which was the high. So overall, the market is expecting recovery, but there's a very big dispersion between those that are growing, those that aren't, and those that are fading.
And just looking through the QMTV lens, What's changed, what's working and what's not?
And the gap between what's working and what's not is getting bigger.
Yeah.
So valuations between those that are doing well, those that aren't, is also growing. So look, definitely the big thing that was the talk of the market 6 to 12 months ago was value was the rally.
Yeah.
So typically like 2016, you had value, anti-quality, and anti-momentum. And that's what's occurred in the last 6 to 9 months, which has now reversed pretty much since about February. It started to reverse quite aggressively. And now here we are pre-results. Quality's working, momentum's working, and it's working in a number of areas. So quality in particular is working in technology. So Altium and WiseTech have been doing well. They're growing. They're winning market share in their respective markets. Their multiples are doing quite well. WiseTech in particular has multiples around 80 times PE. Altium's around 40 times PE, but these are growing at 20%, which is a rare thing in this market. So tech's doing quite well. FinTech also quite well. Hub24 and NetWealth doing quite well. And healthcare, Fisher & Paykel, Pro Medicus, and a number of biotechs. So that's all your sort of quality names, but momentum as well. Momentum pockets are building. So lithium's been still pretty strong. Allchem's up, record sort of levels and doing quite well. Insurance has done well as well. Steadfast, Austbrokers, travel strong, Auckland Airport Flight Centre, and biotech, as I mentioned, in quality and momentum doing quite well. The number of discoveries and then industrial services also starting to tick up as still corporate activity is still pretty decent. So that quality momentum paradigm moving upward is quite positive, and that's very constructive for the market because that's a more trending positive market. And transition and value is still, on my numbers, it's about 60% of the market is in transitional value. That's a big number. It's not normally that big, but all consumer, many industrials, many cyclicals.
So that's a stay away zone at the moment?
No man's land or not in favour, out of favour. It's still an area which is pretty large, and not a lot of things are working in that that paradigm of transition and value. So it's very specific. So consumer, property, industrials, cyclicals, low pricing power, consumers, tough, industrials not spending, cost blowouts, labour blowouts, all these things are all just big negative themes that are affecting that whole group. So that's where, when I look through that QMTV lens, that's where the market is trying to look more positive. You can see quality momentum doing well, earnings up, multiples up. That's positive, that's constructive. But transition and value really struggling. It gives you a signal that the market is still very, very picky, and it wants and needs to have earnings for stocks to work.
And what typically then derails that quality momentum-led rally?
It's usually when valuations get stretched.
Right.
So that's why I think that'll get tested in this results period.
Okay.
So the multiples have been moving and expanding on the expectations that the earnings are going to be there.
Yeah.
Some of them have already confirmed and some of them haven't.
Yeah.
So definitely this reporting season is going to be the time when they need to give those earnings to justify the valuations, and that's what normally breaks that paradigm.
Gotcha. So your expectation then for reporting season, what are you expecting? Are you expecting companies to hit their marks, to hit their guidance? And also, what are some of the leading indicators that you're looking for when companies are reporting?
I think, look, the market should deliver what is expected, and I don't think there should be any massive surprises or shocks in the market. The expectations have come down quite a lot in the last 3-4 months, but sentiment has improved. So that's why I think earnings need to be delivered for that sentiment to have confirmation. And we've seen stocks that got really hammered, like negative earnings or loss-making stocks that had no confidence. Things like Life360 and Megaport had fallen 60, 70, 80%. And just with a little bit of positivity, a little bit of confidence from management, a little bit of we're going to break even, that kind of positivity has meant those stocks are up 60, 70, 80%. Same as some of the lithium names, like Leo Lithium did a deal, cash flow, production, bang, stocks are up 70% over 6 months. So I think you can get a few of those positive surprises. The market's had a lot of negative surprises too. So in consumer land, you've got stocks that are down 30, 40%. In retail land, softer earnings, margins off 4%, but profits down 25%. So those stocks are down. And when you've got fear of either balance sheet or risk of some sort of more fear, the stocks are down 40%. So it's very, very mixed. Like there's positives and negatives right across the market. So I do think the market is going to wants to be constructive. You can see it wants to be constructive by going from those sort of fear to things are okay.
Yeah.
And that's where stocks have gone up 50, 60, 70%, but they've fallen 70, 80% on the way down. So they're not back to where they were in terms of highs, but they've gone from fear to kind of, things are more rational now. So you can see the market wants to be constructive, which is really good. But in order for that mental construct to build, you need earnings.
Yeah.
And that's why I think this is a very important reporting season, because the market's expecting recovery. The market's expecting things to get a little bit better.
Yeah.
It's less scared. And so the market needs a pretty decent reporting season for it to
take another leg.
Yes.
So last month we talked about the consumer and how challenging it is for the consumer right now. What are some of the signs of life we're looking for in terms of that resurgence of the consumer? I mean, it's on the front page of every paper,
correct,
across the country. The cost of living pressures, it's on the top of every political agenda.
Crisis,
you name it, right? We're all
supermarket.
Yeah, exactly. So what are we looking for in terms of that resurgence of the consumer?
It does feel like towards the end of this year that will start to slow down. When you look on the streets, things are still busy. Restaurants, cafes, holiday destinations, airports, car rentals. It's still quite busy. So people are spending on the experiences, but not on stuff, things, products, household goods. And you can see that in the profit warnings. Profit warnings have happened for companies that are based around those categories. But those that are based on experiences, they've done quite well. So Auckland Airport and Flight Centre, travel has done quite well. So it's going to be, I think, quite specific on where things are good. But I do think overall the consumer should feel better and should be trending better by the end of the year. But how much they pull in the next few months is really what the question is. But a lot of those negatives, I'd say, have already been announced.
Yeah.
But again, it's very patchy.
Yeah.
Temple & Webster came out with a good result. It's surprised. Stocks up 20, 30, 40%. But other things that are apparel or household goods, bedding, for example, they're down 30, 40% in share prices because their earnings are off 20, 30%.
Yeah.
So it's very, very patchy. And that's what consumers are too. Consumers are quite patchy. They're spending very selectively.
Yeah.
And that's, I think, what you want is broader confidence. And that's, I think, what you won't get until the end of this year. You'll probably get the start of that.
Yeah.
But until we're there, I think the confidence in the market and re-rating stocks will have to wait until then.
Any insight in terms of the holiday bookings from like Flight Centre and the like?
They've been very strong. They're just expecting them to, because a lot of people have done Europe. There was revenge travel last year.
Travel.
A lot of the younger ones travelled last year. A lot more families are travelling this year.
Yeah.
But then most people have done all of their family and friends or revenge travel by sort of September of this year.
Yeah.
And then it starts to, expectations that will start to slow down, especially for expensive international travel. And the switch has already started to shift back to back to Australia,
Right.
And lower cost barley rather than Europe,
Gotcha.
or generally Asia compared to Europe.
Yep.
That's sort of where the trends are. So you can see that, again, the consumer's being very specific and a lot more particular about where their dollars go because you've got pressures, as I mentioned, supermarkets, petrol, education costs, healthcare costs,
energy's
mortgage costs, energy. So all the pressures are on everyone.
Yep.
And so when you want to have a good time and have fun, you want to be very particular about where you spend that dollar.
Yeah, makes perfect sense. So there's no shortage of things going on. So any final comments on what we and investors should be keeping an eye out for during this next couple of months?
I think, again, it's very stock specific. You need to be careful of pricing power. You need to be careful of duration. So the market, when that value rally happened, the market went very short duration. So I started to think about 6 months ahead. Mm-hmm. Now the market's moving to a year ahead. And then as the market gets more confident, start to look 2 years ahead. Yeah, and that's why quality momentum stocks start to work because the duration gets pushed out to something more normal, which is the 2 to 3 year horizon. So I think that's what you got to do now. You got to push your head out a couple of years because as the market gets less bad, more confident and better, and the consumer gets less fearful and more confident, that's what will start to happen. And that's where the opportunities are if you think a bit longer term.
Yeah.
But also it's fundamentals and stock specifics as well. That's going to matter. There's no easy themes at the moment.
No bargains.
There's no bargains. There's no easy themes that you can just buy and it's in a basket, so it's fine. Everything needs to stack up on its own merits. And still, inflation's still there. Rising cost of capital is still there. So they are higher hurdles for the market to step over. And that's where I think, you just got to be very careful what you say. All traditional things that I could say, like know what you own and not why you own it.
Yeah.
And earnings is really all that's going to matter in this reporting season.
Yeah. Great insights. Thank you, James. If you've enjoyed the episode, please share it with a friend and subscribe to the podcast via your favourite streaming platform. And we'll see you next month.
Thank you.
Some important information on today's podcast. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.